I'll bring Richard back up now, and I'll bring the other panelists up, and we'll have a discussion.
Fascinating. So Kev's going to join us on the panel today, and we've also got Mike Best in the middle there, from the head of logistics from British Land, and we've got Troels Andersen, fund manager at abrdn European Logistics Income. Anyway, so turn the mics on. Right. So I think if we just crack straight into it. Just let you run over there, Kevin. The sector was the hardest hit out of all the sectors in the UK on valuations in the second half of last year. They fell 26% in the UK, which was the largest ever. Obviously, coming off the keenest yields. Maybe, Kev, if you could take this. Do you think we've hit a point of stabilisation now, or do you think there's some way to go?
Well, I think as evidenced by, if you look at some of the headlines in the press about deals happening recently, who's active in the market, and indeed looking at the prime yield which Savills have put on the market, which has come in by 25 basis points, it would seem to me that we have reached a period of stabilisation. For me, looking forward over the next 9 months, the rest of the year, it's going to be really interesting to see the occupational data. It's going to be really interesting to see the take-up data in Q2 and Q3, and it's going to be really interesting to see the vacancy data. My suspicion is that vacancy is going to rise again, probably to a peak of around 7.5%. Now, again, at a headline level, I can see how that would cause concern and may cause problems for where pricing is heading and where sentiment is heading. However, the important thing to do is to look at what's under that 7.5%. And we've seen a rise in what I'm calling occupier controlled space on the market, space for sublease. That is having a distorting impact on the market. What a number of occupiers are doing is bringing 2 or 3 million square feet of space to the market. That's going into our data. But actually, they only want to dispose of around 600,000 square feet. When that's done, the whole lot will be withdrawn. So you've got this inherent volatility in the data. So the point I'm trying to make is, again, I've laboured the point, but to really get under this data and see what's going on. Amazon, another good example. Some of the space that they've put on the market, they want to actually reoccupy by Christmas 24 or Christmas 25. I would question actually whether they're going to find anyone to take it. So it's available, but is it available? It's in our data, but I don't think it's going to be taken, if that makes sense.
Yeah.
So that's where, to answer your question.
And what are you seeing in Europe, Troels?
Well, we're taking the risk, sounding perhaps either as a very naive European or perhaps even arrogant. I think my view is that Europe is different, and well, being part of a UK-based company, I quite often come to meetings where I realize that we, as a business, perhaps haven't been good enough in explaining the differences between, say, the UK and Europe. Overall, our take is that Europe is very strong in terms of fundamentals. We are still some quarters behind in terms of e-commerce penetration, etc. But the prospects for Europe, for continental Europe, are, in our opinion, very, very strong. So Europe is different for the reasons I've just mentioned. Also in terms of rental growth and an increase in not only estimated rental values, but in actual increases in passing rents. Most leases on the continent, they have a very clear CPI linkage, CPI inflation linkage. And to give you a very specific example, the portfolio we manage on behalf of our investors, some 2/3 of our leases have no caps whatsoever on inflation linkage. So, and that has led to a significant rental growth in the passing rent. So in terms of the market, yes, we are seeing yields moving out as well across the world. But in terms of the passing rent, we're in a comfortable position. And again, coming back to what's been said in terms of vacancy, etc., we are trading at, say, around 3%. So overall, the market is strong.
That's good. And what are you seeing on values? Because I think you're a couple of quarters behind the UK in seeing that sort of drop off in values. Is that fair?
Yeah, our house view is that we have taken somewhere around, say, 75% of the pain already. There's still some pain to come, and there's no doubt that the, say, uncertainty about the whole interest rate environment is well, causing a lot of volatility. But in general terms, we are convinced that we have seen the largest repricing already.
Okay. And Mike, what are you seeing in the UK?
I think just to expand on those differences, you've also got to differentiate between what part of the logistics market you're investing in. Clearly, logistics yields were very low, and that was a result of the strong rental growth that was forecast for the sector. And you can't really separate the two. You need the yield and the rental growth. The strong rental growth drives that low yield. And there's quite a disconnect between what's happened to yields, which has been a macro interest rate driven event, and what's happening with the occupational market. And so we focus on urban logistics, where supply is really constrained. There's competing uses from other asset classes. And so to Kevin's point, I think that the supply that we can introduce into those markets is very limited. So we'll still see rental growth, which will support those low yields. And just picking up on one of Kevin's slides with the real for growth, yes, growth forecasts have come down. But if we look back 2 years ago or even 1 year ago in the middle of the pandemic, particularly in urban locations, nobody forecast the level of growth that we have seen over the last 2 years. And that was a result of those really supply constrained markets.
And what are you seeing on the ground in terms of the investment market? Are deals coming back now? What kind of levels are they at? I know Kev said went up to 5% yields, now coming back in again. Is that what we're seeing?
Yeah, so following the mini budget in September, yields moved out. There were a few sellers that needed to sell. They did that before Christmas, and that kind of impacted where prime yields were. Most people that needed to sell have done so. So there's very limited distress in our market. Unfortunately, one of the things that's keeping volumes low, that is making it difficult to evidence where yields are, is that people don't want to transact. They can hold their logistics stock, and everybody's looking for it to be sort of worth more and see more positives on the horizon. So I do think H2 will be much better than H1, but the real problem is not necessarily the level of where deals are going through, just the fact that there's very limited transactions at the moment.
If I may add, for Europe, for continental Europe, I just looking at Jeff from Troels, having just acquired an asset in the Netherlands just recently. We have just recently sold an asset in Spain in a secondary location, in a secondary macro location where that we thought there was an opportunity selling to a French buyer, actually slightly above our Q4 valuation. So all in all, our view is that there is definitely still liquidity in the market. What has changed, however, is that looking at large-scale portfolio deals and some large volume assets, liquidity is limited there. But in the range of, say, between 20 to 50-ish million euro, there's still liquidity in the market. And we are seeing transactions taking place at or even above valuation.
That's good, man. Yeah. So we talk about, Kevin's talked about supply and demand side, and we've discussed it here now. So spec development announcements drying up. Vacancy rates still decent, demand decent. Where is this most prominent? What subsectors of the logistics sector are we seeing that?
What in terms of the supply and demand imbalance?
Yeah, so big boxes.
So I think
box.
if you look at the what I call the traffic light slide that I put up, the one with the different years of supply, the supply is going to be really, really tight at the big end. So that's clear to see from the data that we have. However, if you then start to look at the urban logistics last mile, what I suspect you will see is that the vacancy rate trends upwards, but that covers a multitude of sins, because as I've said, that 1.9 billion square feet of property in the UK, sub 100,000 square feet, a lot of that isn't really fit for purpose.
Mm.
If you were to strip that out, into a grade A vacancy rate and a grade B and grade C, you would see a very, very different story. And if you buy into the narrative that actually, occupiers are going to divert into better quality buildings, then the supply is going to be fundamentally low in that area. And Mike, do you have a view on that urban logistics piece?
Yeah, I think occupiers are definitely focused on the sustainability of their supply chain. Again, in sort of Kevin's survey, you highlighted that it's probably more prominent for developers and for landlords than it is for occupiers, at least in terms of the sustainability of the real estate. But what we're trying to do is make sure we provide these sustainable buildings in the right locations that helps drive cost efficiencies for the occupier in the transport, in running their building. So when we can translate those to direct cost efficiencies, I think there will definitely be a move to higher quality warehouses. And also a lot of that demand that we saw through COVID happened so rapidly that occupiers were forced to take buildings that were perhaps not 100% suitable for what they would like. And so I think we'll also see a little bit of cycling out of the poorer quality, older stock that they took at that point because it was all that's available into new modern stock as that comes online.
Cool. And so obviously, Mike and British Land, you're focused on urban logistics. Troels, your portfolio is?
That's a combination of urban logistics and what we define as mid-box. We have we as a team, we have the pleasure of having colleagues on the ground on the continent. We have large hubs across Europe. So we are very, it's a combination of being bottom-up driven and top-down. So we have local transaction teams. They know the market. They have all the local intel, etc. So we are definitely an income-driven core investor, but we are very much opportunity-driven, given the local knowledge and expertise we have on the ground.
Okay. And so, in that urban logistics area, then, what are the different two massive differences between London, which British Land are focused on, and what areas in Europe would urban logistics work, and what are the differences?
Well, one thing that does come to my mind is, rental levels. I think you definitely cannot compare, say, London with the continent. We are still far behind, below in terms of rental levels. I think what you are seeing in Greater London in terms of underground, multi-storage, etc., we're probably not going to see that on the continent because there is still land available also in urban locations. But I think the prospects are strong in terms of rental growth, etc. And just coming back to what has been said several times this morning, it's very interesting to see that the overall, looking at these businesses' overall cost base, actually the rent is actually a small proportion. We, as property investors, we of course very focused on that rent. But for these businesses, again, I think 6% has been mentioned of the overall cost base. For them, it's very much labor and transport. Again, transport linking that to the urban element, then certainly location is really important.
Yeah, great. So in terms of London then, Mike, I was looking at your results out yesterday, obviously. Some nuggets in there from the urban logistics side. ERV growth last year went up 29% in the urban logistics portfolio, which was well above the guidance of about 5%, I think it was. What is your guidance for this year on rental growth?
So again, London is different from the rest of the UK, and we definitely believe that there's still headroom in the rents. We believe that it will be a supply-driven market, and so we're guiding sort of 4 to 5% per annum from here.
Okay, and obviously you've just announced plan and permission in Paddington for quite a bespoke scheme, quite exciting scheme. What are you seeing on the development side, on the planning side, getting those schemes through? How are you finding that with planners? How easy is that?
Yeah, so in Paddington, we got consent 2 weeks ago for a logistics facility. It's not underground, but it looks as though it's underground. It's below our office campus. It's just our office campus is actually built 2 floors in the air. You wouldn't know it, but it is. So we've got consent for a logistics hub under that, and this is where I think we're sort of trying to be a bit different, because there is such a shortage of supply in urban locations. It's not as straightforward as it has been in terms of buying sites that are pure logistics and holding them or redeveloping them. We've got to find ways to integrate it into those urban environments. And so we're able to, at Paddington, pair our office investment strategy with our last mile logistics strategy. In terms of the planners, they're very supportive. They want to see logistics in more central locations, reducing the delivery mileage. We've committed to that scheme being low or electric vehicles outbound only. So we think by doing a logistics scheme there, we're potentially able to take 100 vans off of Westminster's roads and save up to 3 tons the carbon of all of Hyde Park's trees per year. So I think those things really resonate well with the local community and with the planners. But there's very limited opportunities to actually bring those forward in the most kind of central locations.
Yeah. So what is your pipeline looking like then? I know you've got an exciting one in Southwark that's on the cards. Is that multi-story?
Yeah. So again, we split London into sort of two different ways that we think about it. So from the M25 to the North Circular, where it's quite traditional van-based logistics, and then how we can do stuff really close to Zone 1 and kind of leverage assets that we already own or areas that British Land has historically built other types of buildings in. So yeah, in Southwark we have a development site where we're exploring the possibility of multi-story logistics.
And how easy is that? Because in the UK, there was that one scheme near Heathrow, however many moons ago, which didn't take off very well, and we've had nothing since.
Yeah, so X2 was built just at the sort of dawn of the GFC, so it was a particularly bad time to launch a building like that. It is now fully let, and Segro have traded out of that building. So I think that given where vacancy rates are, the fact that rents have moved on, these multi-story projects become much more viable. But the truth will be in how well it lets and how well it's received by the occupational market.
Just to interject, I mean, I've done a lot of work on multi-story logistics buildings. Savills have a huge operation in Hong Kong, Tokyo, Singapore, and in my view, it's an inevitability that we will see this widespread.
just in London, or?
No, I got into an argument on a podcast recently, and I said in my career, I'm 40 by the way. I said in my career, I think we'll see multi-story warehousing in regional markets in the UK, and the reason I think it's inevitability is because we haven't got any land. Is it going to be easier or harder to build a warehouse on a green field in the future? I don't mean green belt. I just mean a virgin piece of land. It's going to be harder. So the only thing you can do if population grows, the only thing you can do if housing delivery grows, the only thing you can do if online retail continues to grow is go up or down, but down's even more expensive than going up. So I think it will become a planning-led inevitability. Now, arguably, I think because of what's happened in the economy over the last year, that has taken some of the tension away. And so what it may mean is that widespread adoption is further into the next cycle than it perhaps would have been had we not had the economic volatility we've had over the last couple of years. But if you then look at some of the schemes that we've been involved in as Savills, whether that's on the agency side, the planning side, project management, whatever it may be, it's really, really, really difficult from a planning perspective, from a stakeholder, local community perspective. So it's not straightforward, but I just think the pressure on land is going to head it that way. Now, the problem for the market, I may have a view on this, is that if you go back to some of the slides I put up, my view is that vacancy is the key driver of rental growth. So say you're going to build a 5-story warehouse in a market in East London, you can't phase that particularly well. So the vacancy rate goes from 1% to 12% overnight. So what does that do? How do you capture the rental growth, because you're effectively competing with yourself?
Yeah, I think that as those, hopefully we'll see this, and when we see it, I'm sure the first schemes will be, at least a portion of it will need to be pre-let led. So perhaps you're not introducing that whole space into the market at one time. But also we've seen with other landlords that have large portfolios, they're able to take a portfolio approach to their leasing and perhaps manage their vacancy or even accept slightly longer void periods on units because of the value they create across their whole portfolio by waiting for that right rent. So I do think it'll be up to the landlords to the developers to be realistic about the leasing expectations, and then manage that with occupier demand as it comes forward.
Cool. Okay. I think we'll take time now to open up to questions from the room. If we, yeah. Do you want to put your mic on?
How are you guys sort of finding tenant break options? Are you finding that occupiers are actually exercising these break options when they come in year 3, year 5, or are they actually staying longer? Because the valuers will always assume there's a break clause. I've got to assume the tenant's going to break and then we'll allow a void, and that has an impact on valuations. But in reality, is that happening?
I'm happy to have a go at that. For the time being, also given the very low vacancy rates we see again in Europe, no, actually not. These break options are not being used, exercised. And on top of that, again, just being very specific with the portfolio we manage on behalf of our investors, we have a WALT of somewhere around 7 years. taking into account the break options. So for the time being, it's very much focused on, say, engaging with tenants, active as management, where there are discussions to be had. But no, for the time being, not.
You kind of mentioned that development is going to become, inevitably an area of growth from here. So I guess what does that mean for yields, broadly speaking?
I'll have a go. So I think in terms of yields, yes, there'll be more supply introduced to the market, but you're going back to the sort of the fundamentals of the real estate. These are best in class buildings and the multi-story or that intensified development is only going to happen in the most prime location. So I actually think that this will be where they come forward, they'll be very sought after by occupiers. And really, everything comes back to the occupier story. If you can demonstrate the occupier demand, if you can show that through your leasing and through sort of the rental progression as you lease up those buildings, that will be reflected in the ultimate valuation yield. So I don't think that it will be overly positive or overly negative for yields, but in line with sort of new prime products with them across the market.
Cool.
On multi-story warehouses, do you see this just being at the small end of the market, or will this eventually apply to the very top end?
Good question.
I think it'll apply across the board. And as I said, I'm giving myself a long time horizon on that point.
Well, how long are you looking to work for?
Well, we'll see how the market is. I think as I said, if take the Midlands as an area, lots of green space, what seems like a lot of land, to build on, but it's not easy, and as I said, it's not going to be any easier to build on green land in the future. I was reminded just last week, I am still involved in a project 17 years later that still doesn't have planning permission. And so, so the point I'm trying to make here is that at some point we have to go up. And I just think it's an inevitability, particularly in the UK, because of the density of population and so on. I think Europe is different. I think very different. But I think in the UK I can see it.
So, sorry, let's get into the practicalities of this then. How many stories are we talking?
Okay, so I think that you've got to differentiate as well between the product. So traditionally, logistics has always had the luxury of developing a very standardized product that's suitable for all occupiers. Whether that is being used by pallet racking and forklift trucks, or it's used for a cold store, or it's used for a parcel hub. And you go in, some people use the volume, some people don't, some people employ automation, some people don't, but everybody operates in the same landlord constructed building. What we will see with multi-story is a bit more specificity around the type of product you're developing, and it won't apply to the whole market. Only certain occupiers will be able to go into certain buildings. So if you're out in the Midlands, you're still, you might maybe build 2 stories eventually, but the building will be fundamentally the same as it is today. You'll take your vehicles up to the upper floors, you'll still be able to rack it. It won't really be any different. If you're in the very central locations in London, where clearly bringing forward new logistics is much more challenging, then you'll have to change the specification. And so if occupiers want access to those really central locations, they won't be taking vehicles up, they'll be using lifts. And if you're using lifts, you're not limited to 2 stories, you could do 3 or 4. And you'll have smaller footprints because you're in central locations. So I think the products will be very different, and that we'll design for specific subsectors of the occupational market rather than delivering, a general product.
Yeah, I don't want anyone to get the wrong idea. I'm not suggesting we're going to see 17-story warehouses like we have in Hong Kong on the side of the M1. I'm not suggesting that. But what I am suggesting is there will be a greater intensification of the land that may facilitate itself in 1 or 2 levels, bigger densities, whatever it might be. But I think this intensification, that's the inevitability.
Okay, and then on rents, how will that work? Will it have a different rental level for higher stories, or would you rent it out all at the same sort of level?
I mean, again, this is a new market at least for the UK. It would be a new market for Europe. There are examples kind of elsewhere. It'll come down to occupier demand. Clearly, we'll try and get the best rents on every floor. I don't think that there should be a discount as you go up the building, particularly in examples that we've seen elsewhere. Actually, having the top floor, having the views, having the amenity space, there are different things that are attractive to occupiers. What it comes down to is that type of occupier. Some occupiers will want to be at the ground floor, some occupiers will want to be at the top.
Well, I've got loads of questions here. Do you want to go, Matt?
Just following on from Richard's question. So if the rent is the same or maybe it's lower as you go up because of the inconvenience factor, what about build costs as you go up, as you build double-story buildings? Is it twice the cost, or is it more? So what's the cost difference between a 250,000 square foot as a single-story building or 250,000 square foot over 2?
Yeah, so adding. I mean, again, we haven't built one yet. We're hoping to build one. We've got planning permission, has been submitted for one of these schemes. Adding the second floor is more expensive. Like, your build costs go up probably double the floors. No, probably 50%. But then adding a third or a fourth floor, it doesn't go up again, because if you imagine, once you sort of introduce that reinforced level, you can add those levels at the same rate. But what you've gone away from is having just a steel portal frame that's clad.
Okay, so move on. Question here.
Just a quick one. What makes more money for multi-story, especially in London, a car park or a logistics warehouse?
Not a car park expert, so can't really compare the two. I think.
So what if if you're head of British Land, which you are, if someone said to you, this is what we're going to build, the same unit, but we're going to convert it, instead of a warehouse, we want to put a car park into it because the investor wants that. So what would your decision making be?
Well, people, again, it depends who you are, but in the very central locations, people are using cars less and less. I think it would also be really difficult to do with planning policy.
Probably a prime area then, because where there's sort of supercars, they use those lifts a lot. They're never going to get rid of their cars, Mayfair, etc. Those really prime areas that you mentioned earlier.
Yeah.
So what would you say there?
We would opt to do logistics, absolutely. Okay. I think the demand for supercar storage in London is probably not as, the market isn't as deep as we would like it to be, whereas I think logistics, that there will be demand. Also, I think if you're building new, actually delivering car park space in the central areas is kind of discouraged. We're looking to reduce the amount of cars in our central neighbourhoods. With TfL are looking at low traffic environments, low traffic neighbourhoods, and actually what we're doing, a lot of the development that we're doing in other sectors, particularly like office, residential, for example, Canada Water, we definitely want to introduce logistics to at least serve the new development we're doing, even if it can't serve the wider market. But the ambition would be to serve, not just our own developments, but the wider community too.
That's interesting. I think we've got another question here.
Yes, interesting point that you made, Kevin. Something that I was discussing just in the break actually was to do with the challenge of the EPC targets the government have set, particularly with respect to the last mile urban logistics market. The UK, the length and breadth of the UK is sort of populated by fairly aging estates used by white van man, for want of a better description. And whilst I can see the opportunity, certainly in some parts of the country, the southeast most obviously, the viability challenges in other parts of the country might be slightly trickier. It's I know from experience that it's very, very challenging to get most of these estates, which, as you say, are sort of typically D, E's, and sometimes F's, up to a C. Opportunity or threat? Discuss.
Well, I did say in the presentation that we discussed it in the panel, and I was hoping that my colleagues would step in here. I think overall it's an opportunity to either improve what already exists, and that may be knock it down and start again. But then you get into the whole embodied carbon debate and so on and so forth, or it's an alternative use. If you look at that length and breadth of the country, I did some really interesting analysis a couple of years ago, and the amount of multi-let estates, industrial areas that are built by canals rather than roads is astonishing. So actually, fundamentally, a lot of this is in the wrong place because it stems from the 1800s. It wasn't an industrial area; it still is. So actually, there is an opportunity there to get these buildings in the right places. But then, if you go back to what I was saying a minute ago about is it going to be any easier to build on green land, then no. But overall, I think it's an opportunity, but that swerves the question a little bit on viability. But if you take that helicopter view, I think it's an opportunity.
Oh, sorry, we're almost out of time. There's one more question here that I wanted to go to just before we wrap it up. Let's turn it on. There's a button at the base.
We can hear you.
There you go.
Thank you. My question is about the portfolio approach for leasing. As the vacancies rates go up, and probably because of the supply constraints, do you see a trade-off between, let's say, government penalizing for keeping the vacancy rates higher and waiting in the market to get higher rent?
Yeah, I'm more than happy to try to answer that. I think that very much depends on the investor profile. Again, us being an income-driven investor, all focus will be on the income side of things, and where there is rental value to be captured, BI capital growth over the longer term. Of course, we would be looking into that as well, but our priority would be income. So I think it depends on the investor profile.
I'd also add that in the UK there already is a penalty on doing that because you get charged empty rates. So there's an economic balancing point as to how long you want that to be vacant and how much rental sort of premium you can wait for. So that already exists, and that's it's only for those landlords that have a portfolio and can actively create value by doing that.
Cool. Well, thanks a lot, everyone. Thanks a lot for the panel. That was really interesting, and we just went over time, and I knew this one would be hard to keep within the time, but thank the guys for the panel.